Hello, I'm Bernard Hickey from interest.co.nz and welcome to an investing report brought to you in association with the BNZ. Today we report on the announcement by St Laurence Limited, which is run by Kevin Podmore, that effectively it has defaulted on its moratorium plan. Now this plan was agreed in late 2008, immediately after many finance companies collapsed after investors tried to pull their money. But the moratorium plan for St Laurence promised to give all the money back, and that was about $240 million to more than 7,000 investors. Now St Laurence has made 5 payments, but that only totals 10 cents. And now it's saying it wants a full debt for equity swap. It says because of the collapse in the property markets, it virtually is worth nothing, and that the bondholders, the debenture holders, are in control of the company. It wants a debt for equity swap instead of a receivership. It'll be interesting to see whether they get that through. Remember, we had with Geneva Finance and with Hanover Finance debt for equity swaps, which haven't been a huge success, particularly in the wake of the Hanover Finance deal with Allied Farmers. It will be interesting to see whether St Laurence get this through, and whether mums and dads who invest in St Laurence believe this is the best way to go forward. Before they vote, they'll get a report from Grant Samuel. A report from McGrath-Nicol to St Laurence apparently says, we haven't seen the details yet, apparently says that any receivership would result in, quote, minimal value being returned to investors. Currently investors have only received 10 cents out of every 100 cents, so minimal implies that there's not much left. Another disaster really for mums and dads in a finance company debacle that has lasted for the last 2 to 3 years. That's cost at least $3 to $4 billion in lost deposits out of a sector which only had $9 to $10 billion to start with. I'm Bernard Hickey. That was an investing report brought to you in association with the BNZ.